All right, let's dig into Lee Enterprises' latest quarter. This one is a fascinating case study because you've got two totally different stories playing out. On one side, you have some pretty rough numbers, and on the other, you have a management team that sounds incredibly optimistic. So what is actually going on here? Let's break it down.
So this is really the central question, right? Lee missed what the analysts were expecting for both revenue and earnings. I mean, that's a double miss. And yet, if you listen to their conference call, the leadership team sounded, well, pretty darn positive about the future. And it's this disconnect between the tough numbers we can all see and the rosy picture they're painting that we're going to unpack today.
Okay, first things first. Before we get to the story, we have to look at the numbers, the hard data that caused the market to react the way it did.
Ooh, yeah, the miss on the bottom line was pretty big. The consensus on the street was for a loss of about 13 cents a share. Instead, Lee reported a loss of 31 cents. So that's an 18-cent miss, a number that definitely gets investors' attention and not in a good way.
And the story on the top line wasn't much better. Revenue came in at about $141 million, which was more than 4% below what analysts had penciled in. So bottom line, the company just isn't performing up to what the market was expecting.
And this wasn't just about missing a forecast for the quarter. The business actually shrank. Total revenue dropped 6% compared to this exact same time last year. And that's a really crucial point because it means the whole pie is getting smaller, which puts a ton of pressure on that digital growth story they're trying to tell.
Now, to be fair, management did offer up a reason for some of this weakness. They pointed back to a ransomware attack they had earlier in the year. They said it cost them about $2 million and really messed with signing up new subscribers. And look, that's a legitimate issue for sure. But the market, well, the market usually doesn't have a whole lot of patience for these kinds of excuses.
Okay, so with that pretty tough backdrop, let's switch gears and look at how management is trying to get everyone to focus on something else. I mean, for a company like Lee that comes from the world of newspapers, the slow death of print it's a huge deal. So they want you to look past today's numbers and really buy into their vision for a digital future.
And this slide right here, this is their number one talking point. I guarantee it. For the very first time, digital revenue is now more than half the business, 55% of the total. For them, that's a massive, massive milestone. It's the proof they point to that says, see, our pivot away from print is actually working.
And when you peek under the hood of that big digital number, there are some genuinely bright spots. Digital-only subscriptions, up 16% from last year. Their digital marketing agency, up 10%. Plus, they're launching a whole new suite of AI products, and on top of all that, they managed to cut their cash costs by 7%. This is the positive story they're selling, and you can see why they're excited about it.
So, to make this vision feel less like a dream and more like a plan, management laid out this multi-year roadmap. It's all about getting customers to use their new AI tools, putting that cyber attack in the rearview mirror, and hitting this key goal they call digital sustainability by 2026. Basically, that's the point where their digital business is strong enough to carry the whole company. And the big prize at the end? A goal of almost $500 million in digital revenue by 2028.
So you've got the crummy quarterly numbers on one side and this ambitious, forward-looking digital story on the other. How did the market, the ultimate judge and jury, weigh these two conflicting messages?
Well, the market's verdict was swift, and it was pretty brutal. The stock dropped 8% on the day of the announcement. So despite all the optimistic talk about AI and the digital future, investors were laser-focused on the here and now, and they clearly did not like what they saw.
And this slide, this really gets to the heart of the problem. It's like management and the market were having two completely different conversations. On the earnings call, management is talking up the 55% digital mix and their AI future. But investors, they're just staring at their screens, seeing that big earnings miss, the revenue shortfall, and they're worrying about the company's debt load. It's a total disconnect.
So where does that leave us? Let's put it all together in this final section and give you our take on what to expect from Lee Enterprises going forward.
You can really boil this whole thing down to a simple bull versus bear debate. The bull case, that's the story. It says the digital pivot is working and AI is going to be a huge new growth driver. The bear case is all about the numbers we have today. It says the transformation keeps missing targets, the old print business is a massive anchor, and there are just too many risks to the plan. So for our prediction next quarter, we think this tug-of-war is going to continue. We do expect to see their digital subscriber numbers get a little bit better as the effects of that cyber attack finally fade. But we're also forecasting another miss on earnings per share. Why? Because the investments they're making in AI, plus the never-ending decline in print, are probably going to keep squeezing their profits.
So putting this all together, we're officially assigning a market perform rating to the stock. Look, the progress they're making in digital is real. You can't ignore it, so we can't be totally bearish. But these recurring misses and the risks to their plan mean we just can't get bullish either, at least not until we see some consistent profits.
And at the end of the day, this is the key takeaway. The strategy they have makes sense, and the digital growth is definitely happening. But the market is now in what we call a show-me phase. Investors need to see this transformation turn into actual, real, consistent profits before they're going to be willing to bid up the stock.
And of course, a final reminder for everyone. This analysis is for educational purposes only. It is not financial advice.